Chip stocks are crashing, and it's sending shockwaves through the economy. Just a year ago, AI-driven demand sent these companies soaring. But now the party is over. What went wrong? Kioxia isn't alone. Its 16% crash is echoing across Asia and the US. This isn't just a correction. It's a pivot, signaling that the AI boom may be cooling faster than expected. Tsmc's decision to pump another $100 billion into its Arizona facility.
What does this mean for the global economy as these Asian markets set the pace? This chip crash isn't just about stocks, it's a warning sign for the economy. When AI-driven demand slows, productivity growth stalls, and interest rates stay high, it means the engine behind economic recovery is sputtering. Governments are betting on AI to boost productivity and lower costs. But if this pivot happens faster than expected, we could see a ripple effect across markets, jobs, and even global trade. But here's the twist. Even as AI demand slows, governments around the world are banking on this tech to boost productivity and lower interest rates. Australia's Treasury.
Meanwhile, chip stocks could rebound if new demand emerges, but for now, caution is warranted. Stay sharp. This volatility isn't just about chips, it's about the future of the economy. This chip crash isn't just about stocks, it's a warning sign for the economy. Governments are betting on AI to boost productivity and lower costs. But if this pivot happens faster than expected, it could ripple across markets, jobs, and global trade. The question now is whether AI can drive growth without dragging the economy down with it. If you want to stay ahead of market shifts like this, subscribe for more deep dives on tech and economics.